Danielle DiMartino Booth joins us. She's one of our faves. She's a CEO and chief strategist at QI Research. She looks at data that I don't even know where it comes from. And, she doesn't rely upon the government stuff. She gets her own data sets. I have no idea where that comes from, but it's really, really smart and really helpful here. Danielle, thanks so much for joining us here. Again, with the dearth of economic data out there, for those of us that are trying to figure out where this economy is going, what are you looking at? What are you seeing out there in this U.S. economy?
So, I think the good news a month ago is that QI Research was always looking at alternative data sets. There was a Reuters poll that came out that said that 89% of economists did not trust the official data prior to the shutdown. So I don't think that I'm necessarily alone. But anyways, to answer your question, we look at Macro Edge, which is an alternative to Challenger. They use kind of big data to scrape headlines. For the month of October, we learned that it was almost 155,000 job cuts that were announced. And that helps to kind of put into context what we heard from ADP this morning, because these were large companies making big job cut announcements. And yet what we saw for the month of October is that ADP job creation was exclusively with the largest companies. Of course, you count an employee as being on the payroll until their severance runs out. So we know that that's kind of a ticking time bomb. We follow Google Trends. Every day, Americans search or don't search to file for unemployment. And when you look at that, the 2025 trend really has gone off of what we saw in 22, 23, and 24. We also follow individual state WARN notices, which they have to provide to workers when they're going to be laid off. And right now, in the aggregate on a nationwide basis, WARN notices are running at the highest pace since September 2009. So the data's always been there. You just have to know where to look.
And what does all this mean for the Fed and that December meeting, in just a few weeks? Are we going to get one more cut, do you think, before the end of the year?
Well, I think given the headlines that we've seen subsequent to Powell being at the podium, in the beginning, the odds of a rate cut ticked down to like 55%. Now, as of today, we're back up at 70%. And I think that that's because we're not seeing, especially when you hear from companies like Kava and Chipotle, we're not seeing companies able to pass through higher costs to their end customers. And that means that there's not going to be as much pressure on the Fed's inflation mandate as there is going to be on its employment mandate. And I think that that's why we've seen odds of a subsequent December rate cut hover around this 70% level. And Jerome Powell's never defied markets when it's been north of even 50%. So there is the presumption in the markets that we will see this next rate cut.
Danielle, so we've seen a lot of, I guess, headlines on layoffs and from companies we all know and people can relate to. Is that headline risk, or does that really reflect, oh boy, we've got a labor market that's at the margin really kind of struggling here?
Well, I think it's the latter of the two. Yesterday, we heard from TripAdvisor, American Airlines, IBM, and every day we seem to get a new laundry list of companies. And I think that it's indicative that it's more endemic. Kind of at the beginning of the year, we had this so-called low hiring, low firing situation. And Powell warned when he gave a speech a few weeks ago that if we see a continued lack of hiring, but also see a pickup in firing, that really does change the construct. It's going to change the Fed's thinking. And I think that that's where we are at this point.
Danielle, I just want to get your thoughts on AI, because we seem to be doing that every day with our guests. And earlier we had Brad Conger on. He's a chief investment officer over at Hurdle Callahan. And he said that he thought the AI data center boom was a big, huge bubble. He went on record saying that. What are your thoughts on that?
Well, I'm not an expert in this field, but I would have to say that Bain Capital would have agreed just yesterday when they came out and they said that they were not going to be joining with other large investors in trying to pump up this boom. We also know, this is the day after Election Day. We also know that a lot of communities are pushing back against these data centers being in their backyard because one of the two main sources of inflation are food prices and electricity prices. But yes, when the United States has 10x that of Germany or China in terms of the number of data centers, it brings you back to the days of fiber optics and makes you question, is this fiber optics 2.0? I would agree with your guest earlier today.
Yeah, and I remember those fiber optic days when that was kind of the bomb, and telecom stocks were going crazy. Danielle, on the inflation front here, you know, the headline numbers, they're still a little bit above, obviously, where the Fed would like to see it. But boy, I kind of feel like we're dodging a bullet here on this tariff inflation here. Is that right, or is it still perhaps to come?
You know, listen, to your point, ISM came out a few days ago and said, we are no longer seeing the effect of tariffs in our price structure. Wow. Manufacturers, factories are no longer feeling these tariffs. They've mainly come through the pipeline. And in fact, what we're seeing now is one company after another saying they've got too much inventory on hand because they had a lot of stock building going on into the tariffs, and now they're trying to work that down. And we're hearing from one company after another, especially in the housing space, that they've simply got too much stock on hand right now, and they're having to discount to get rid of it. So you're actually seeing the opposite effect on inflation due to tariffs.
Do you think also that just they've been successful negotiating with other countries, or with, you know, whatever it is they have to pay at the ports? I mean, there's got to be some heavy duty negotiating going on here. It's hard to believe they're absorbing all the cost.
Well, yes. And you hear one company after another say, we have found alternatives. It's like I'm finding alternative data sets every day. Companies are finding alternative suppliers if need be. And I think that is something that is probably a healthy development, because you always want to be able to, whether it's hedging your portfolio or hedging your supply lines. And I hope to see this trend continue going forward, because I think it could have been pursued more aggressively after COVID, and it was not.
Danielle, thanks so much for joining us. We always appreciate getting a few minutes of your time. Danielle DiMartino Booth, CEO and Chief Strategist, QI Research, one of the smarter folks we chat with. She spent about 9 years at the Federal Reserve Bank of Dallas, so she knows a lot about the Fed, how the Fed looks at data, reacts to data, and it's always good to get her perspective.